Welcome to the Capital News. I am your host, Alex Karitis. Today is Thursday, February 4th, 2021. Thank you so much for joining me. Title of today's podcast, Job Slide, Market Highs. So we're going to do our typical Thursday podcast, initial jobless claims, which came in better than expected, but still a bad number. Still another heartbreaking number, which we'll get to here shortly. Also going to continue to talk about the Federal Reserve's balance sheet, the changes to M1 and M2 money stock. And then, of course, we had Dingbat Janet Yellen, the Treasury Secretary, along with other regulators today, meeting to discuss the frenzy that occurred last week with respect to GameStop, AMC Entertainment, BlackBerry, and a handful of other stocks. We know the names. We talked about this at length last week. So they just wanted to get together to see what really took place and if they can get to the bottom of it, and if regulators have to do something because they're so worried about transparency, and they're so worried about markets being fair and equitable and not being distorted. The nerve and the audacity of these people for this type of language to come out of their stupid faces is ridiculous. It's repugnant. They have done more to distort and destroy our markets and financial system than anybody else. And now they're the ones who are supposed to swoop in to figure out what happened. And then once they do, you know they're going to do something. There's going to be more regulations. There's going to be more laws put on the books. And if they go after somebody, it's not going to be after some bigwig. No, it's going to be after some little guy somewhere that they're going to put the blame on. Just watch. This is just getting started. Just getting started. And just wait. There was an ethics waiver that had to take place with respect to Janet Yellen. Just wait till find out why. So first to some market performance, just some headlines to get these out of the way. We have the Reserve Bank of India keeping its benchmark repurchase rate at 4% at its February central bank meeting. And it, of course, is going to do whatever it takes for as long as it takes to allow the markets to stabilize and get back to normal, whatever that means. We have Germany factory orders drop more than expected. Not so good there. We continue to have the increase in oil prices and natural gas today. We'll get to that momentarily. Philippines inflation rate hits a 2-year high, but there's no inflation anywhere, so don't pay any attention to it. Australian retail sales drop for the first time in 3 months. I thought everything was getting back to normal. Maybe this is just a hiccup. Maybe it's the start of something else. But we have the dollar index trading at 91.54, so a continuation of a little bit of a climb here with respect to the dollar strengthening. Some broader weakness against the major currency pairs, again with the dollar strengthening for the past couple of days. Bitcoin is trading at $37,700 per coin. Today's topic, today's headline, job slide market highs. Last week, we had the market frenzy. Yes, we had some stocks going to the moon. Beyond that, but overall, the markets were coming down. And they dropped pretty nicely for a week. Now, all of a sudden, everything, I guess, is A-OK, perfectly back to normal. And the major averages have hit all-time closing highs. Now, yes, it's earnings season. Yes, there is a lot of earnings beats out there on the street. And I think that's because a lot of these market analysts are sandbagging it. I think they've set the bar so low that it's extremely easy for a lot of these companies to beat it. Furthermore, because we know about the consolidation and we know about so many small businesses being wiped out because of these policies, well, that business ends up going somewhere, right? And it goes to a lot of these other bigger companies that happen to be publicly traded. So they're picking up the market share. So we're going to see how long this continues. But nonetheless, the markets have hit an all-time high. Just 1 week after some chaos. But overnight futures trading, we have the Dow Jones Industrial Average up about 0.1%. The S&P 500 is up 0.25%, and the NASDAQ 100 is up 1/3 of 1%. A big rally over in Asia with Japanese markets gaining 1.5%. A mixed bag across the pond in Europe, but mainly up, with the biggest gainer being the Spanish markets putting on a gain of 1.4%. The FTSE, the UK market, was slightly in the red but flat for the day. And the Australian markets are up 1.1%. And just to mention it, because there was a sell-off, broad-based, across the globe last week, but we have the Indian markets at an all-time high. Last week we said, well, it looks like they might have, your run-of-the-mill 10% correction from an all-time high of about 50,000 points on their exchange, came back down to 46, 45-ish, close to it, so close to that 10% correction. And then a week later, they've hit another all-time high. These markets are completely just disconnected from reality. It's all a central banker's fantasy. That was the title of the other day's podcast. It's a central banker's world. That's what it is. We're just living in it. They print the money, up go financial assets. With respect to WTI, we're at $56.53. Brent is at $59.11. Natural gas is north of $3 once again, $3.02. Gold got shellacked today, below $1,800 an ounce. Haven't been here in a few months, but trading at $1,799 an ounce right now. Silver at $26.51, so still hanging on to that 26 handle, which I like, despite the fact that it obviously has been selling off for the past couple of days after it hit a 8-year high the other day at around $30 per ounce. So that's something to continue to monitor. And as we stated yesterday, with Inflation Nation, if we continue to see the run-up in these energy prices, we're going to continue to see consumer costs and consumer prices go up as well. Transportation costs, we're already starting to see transportation costs go up, and quite aggressively. I came across an interesting bit of data today with respect to shipping rates, overseas shipping rates from container ships going from Shanghai to Los Angeles. It's at an all-time high, and we're basically twice the previous all-time high. So just buckle up. We were just getting started here. We continue to see a lot of disruption. We continue to see supply chain disruptions. We continue to see bottlenecking at various ports around the world. So this is going to have a negative effect on prices, meaning prices are going to continue to go up, plus everything that the central banks are doing with the actual generation of inflation, increasing their respective money supplies, and then whatever the governments are doing, borrowing, spending, and begging for more. So this is a recipe for disaster, and quite honestly, gold and silver should be doing much, much better, but we know how rigged and manipulated those markets are. And of course, we have Janet Yellen and company just ignoring it and saying they have to focus on something else. And to round it out, Uncle Sam's 10-year junk note is yielding 1.13%, so little change from yesterday, but still worth monitoring because the bond market would happen to be doing one of two things. It's either projecting growth is coming, which I don't think that's the case, or it's inflation, which I do think it's the case. And if we continue to see these yields go up across the yield curve, well, then what's the Federal Reserve to do? Are they going to say, well, we don't like interest rates being up this high? I mean, the whole purpose of quantitative easing and all this money printing is to suppress interest rates, is to keep them down. Well, I said, the Federal Reserve and other central banks might be extremely powerful, but none of them, even combined, are larger and more powerful than the markets. So if the markets are trying to push yields up and they're going to fight with the Fed, well, what's the Fed going to do? Are they going to allow these yields to continue to go up, which will obviously have a ripple effect to other borrowing costs, such as mortgages, what have you, and those costs will start to go up as well. Well, that's not what the Fed wants. At least that's not what they say publicly. So they have a couple options. They can either allow these yields to continue to go up, or they're going to have to print more money to go into the bond market to buy them to get those rates back down. So this is, in effect, the Federal Reserve fighting inflation with inflation. This is why I'm saying they're trapped. Because if they say, whoa, you know what, these interest rates are too high and we don't want to fight inflation with inflation anymore, meaning now we are also going to increase interest rates in an attempt to put a lid on them, in an attempt to put a lid on the rising inflation that they're finally admitting to, well, how do you think the stock market's going to respond to that? I mean, we couldn't handle a couple basis points, 2.5%, 2.25% on the federal funds rate in the fourth quarter of 2018. We had a 20% decline in the stock market in a couple of months. Could you imagine what's going to happen now? So they're trapped. This is what I've been talking about for 2 years. This exact scenario, it is unfolding. They know it. That's why they're nervous. That's why Jay Powell last week, after the conclusion of the first year's Federal Open Market Committee, is saying, oh no, the Federal Reserve has nothing to do with asset prices now all of a sudden. That's all on the back of Congress and markets anticipating further stimulus, and because the vaccine rollout is so far so good. They are stepping back. This is cover your rear end. This is shift the blame. And that's what they're going to continue to do. They're trapped. They know it. It's either print more money or increase interest rates to combat the rising inflation. Neither scenario is good. Which one are they going to pick? We're going to know because we're going to find out in the not too distant future. With respect to initial jobless claims for the week ending January 30th, 779,000. That is the seasonally adjusted figure. For the week ending January 23rd, we had a downward revision, a rare downward revision of about 35,000 jobs. So that takes January 23rd's number down to 812,000. We'll take it. That's a good thing. On a non-seasonally adjusted basis, the number for the week ending January 30th came in at 816,000. So these are still heartbreaking numbers. These are still well north, over 100,000 jobs north of where we were during the depths of the great financial crisis over a decade ago, where we came in at about 660,000, and that was only for a couple of weeks. We have not been below 700,000 since last March. Think about that. Think about how devastating these lockdowns, these restrictions have been and remain to be. The great financial crisis was one of the worst economic and financial crises in human history. One of the worst that we've had in this country since the Great Depression. And 650,000 was the peak during the depths of that crisis. And we haven't been at that figure in almost a year. Think about how devastating this all truly is. Continuing claims for the week ending January 23rd with a 1-week lag is at 4.6 million. That is the seasonally adjusted figure. For the non-seasonally adjusted figure, it comes in just about 5.1 million. Both of these are down from their prior weeks. So that's continuing in the right direction, but we know where a lot of that ends up shifting onto PUA, PEUC, extended benefits, what have you. For the week ending January 30th, with respect to pandemic unemployment assistance, one of the children of the Nobody Cares Act, we are at 349,000. That is a decrease of about 55,000 from the week prior. When we take everything together for the week ending January 16th, recall this lags a couple of weeks. Regular state unemployment, federal employees, newly discharged veterans, PUA, PEUC, extended benefits, state additional benefits, and work share, we get a grand total of 17.8 million. This is a decrease week over week of about 486,000. So that's in the right direction. That's what we want to see. The question is, how long is this going to remain the trend? We want this to continue, obviously, but we've had some head fakes before. A couple of weeks ago, we saw a drop-off of over 2 million, and then the following week, we saw it go right back, and that was because there was a lapse between Nobody Cares Act 1.0 and Nobody Cares Act 2.0. Okay, so we'll continue to monitor this closely, but that is where we are. 17.8 million Americans still claiming some form of unemployment insurance. And then tomorrow is the first Friday of the month, so you know what that means. That is the jobs report for January. And of course, we will cover that either tomorrow or on Saturday. And recall the jobs report last month, obviously that would have been for the month of December, came in at a loss of 140,000 for the month of December. So hopefully it's not as bad this time around, but I'm not going to be surprised if that's the case, because we know about the restrictions, the lockdowns, the holiday season, and any type of big rush to get some extra labor in various warehouses, what have you, would have been laid off once again. So we'll continue to monitor, and we'll have that discussion again either tomorrow or Saturday on the January jobs report. For the Federal Reserve's balance sheet, we stand at $7 billion. Yeah, don't we wish? $7,410 billion. $7,410 billion. This is near an all-time high, but just $4 billion shy of being there. So we're sort of plateauing for the past couple of weeks. but we're near all-time highs, that's for certain, and we will, of course, be much, much higher in the not-too-distant future. I'm still holding fast to my prediction that by the end of this year, we're most likely going to be around $10 trillion with the Federal Reserve's balance sheet. For one reason or another, because Congress passes more bills and they need to be financed, or because the yields continue to go up on the Treasury market and the Fed has to act and do something. With respect to M1 money stock, we are at an all-time high, $6.9 trillion. The week prior, we were at $6.7 trillion. So this is quite an increase, and maybe this is sort of the real stimulus that's behind the increase with respect to the stock market. That's what the currency is, folks. That's where all of the cheap money is making its way, and this just continues to climb. It's a vertical line. Again, I always suggest to the audience to look up this data as well. I'm not paying for this data. This is not behind any type of password. This is open to all of us. It's actually brought to us by the Federal Reserve themselves, the Federal Reserve Economic Data, acronym FRED. Google FRED, Federal Reserve Economic Data, and you can easily find a lot of this stuff. M1 money stock, put it in the search bar. Looking for the Federal Reserve's balance sheet, type in assets. It should come up. Please do yourself a service and look at these things. And you just understand, just as soon as you look at them, that this is completely unsustainable, unhealthy, and just out of left field, because we've never done this type of thing before. And it is not going to work. We know this because we've tried some of these things before to a lesser degree, and they didn't work. So it's going to buy us time. It's going to juice markets. It's going to fill a void for a little bit, but it's not real. It's not real growth. Real growth is production. Real growth is investment. This is a printing press. This is throwing currency into the ether and hoping something sticks. That's not how it works. If that's how it works, then we would be taking lessons from Zimbabwe and Venezuela and Lebanon and Argentina and Turkey and Iran. They would be the envy of the world. They would have the largest economies on the planet. But they don't, because a printing press is not a solution. It's not a panacea. It's part of the problem. And it's a major contributing factor to the issues that we are facing and going to continue to face. And then with respect to M2 money stock, near an all-time high, but a little bit of a pullback. Last week was an all-time high. This week we're at $19.514 trillion, a slight decrease from last week's all-time high. So it's just taking a breather. You know, I'm not nervous about this. It's just a breather. They're going to continue to go higher too in all of these metrics, and we're all paying for it. Now, this is an article out of Reuters. Yellen seeks to understand deeply GameStop frenzy as market regulators meet. Ah, fabulous. U.S. Treasury Secretary Janet Yellen on Thursday vowed to protect investors. She vowed to protect investors. She has screwed over investors. She has screwed over savers and anybody trying to make an honest living in this country with the policies that she chaired and oversaw as the chairman of the Federal Reserve. Yeah, but she's vowed to protect investors, but said financial market regulators needed to fully understand the recent trading frenzy involving GameStop Corporation and other retail stocks before taking any actions. The core infrastructure of financial markets had proven resilient during the high volatility and heavy trading volume around GameStop and other stocks, according to Yellen, after a high-level meeting with other top regulators to discuss recent market volatility. But a timely study of the events by the Securities and Exchange Commission was important, Treasury said, adding the SEC and Commodities Futures Trading Commission were reviewing whether the trading practices were consistent with investor protection in fair and efficient markets. No, our markets are not fair and efficient. This is a bubble mania driven by cheap liquidity that keeps getting thrown into the system because there's nothing else they can do about it. Because if you allowed markets to connect with the underlying economy, we would not be anywhere near all-time highs on the market. It's a disgusting display. Another 700 and some thousand people filed initial jobless claims last week. We still have tens of millions of Americans going to food banks and facing evictions. And markets are at all-time highs. You just wait. Pitchforks, they're coming out. Yellen told ABC's Good Morning America earlier today it was critical to ensure that our financial markets are functioning properly, efficiency, and that investors are protected. Protected from who? Most definitely not from market manipulators. No, not at all. But the manipulators are protected from prosecution. In her first media interview, Yellen said President Joe Biden's $1.9 trillion federal stimulus plan was needed to alleviate the economic pain caused by the coronavirus pandemic, which has left so many Americans jobless. Oh, yes, isn't that right? Another $1.9 trillion that we don't have needs to be thrown into the system. Quote, we never had anything so large, even during the Great Recession. We need to make sure people have jobs. If they don't have jobs, that they are supported, according to Yellen, referring to the 2007-2009 economic contraction in the United States. She said Biden will continue to work with Congress to pass the plan on a bipartisan basis and is looking to cooperate with Republicans. So Yellen convened the heads of the SEC, the CFTC, and the Federal Reserve Board and the Federal Reserve Bank of New York to discuss retail trading and whether or not the recent events warrant further action. We need to understand deeply what happened before we go to action, but certainly we're looking carefully at these events. Of course, she did not specify what potential actions could be taken by regulators to respond to the situation, and they're not. They're going to pull them out of a drawer with a whole bunch of legislation in it that's been collecting dust because they were just waiting for some type of event to occur so they could spring it on the unsuspecting American people. Many on Wall Street have been stunned this past week by the sharp gyrations in shares of video game retailer GameStop, headphone maker Koss Corp, cinema chain AMC Entertainment, and other stocks and commodities favored on the Reddit social media site's Wall Street Bets forum. Traders had bid the shares to dizzying heights in an effort to punish short sellers who profit when shares fall, forcing some hedge funds to close their positions at heavy losses. But the so-called Reddit rally later collapsed, exposing many individual traders to huge losses themselves. The entire point I was making last week. People are not sophisticated. They're following the leader, and they have no idea who the leader is or was, and we may never know. Despite what type of investigations all of these pinheads do, we may never know. But what we do know is a lot of people got hurt because of this, and needlessly. GameStop shares closed Thursday down another 42%, trading at $53.50, far from their peak of $483 just 1 week ago. AMC Entertainment has lost about 2/3 of its value after 2 weeks of wild swings. Gee, I wonder why. I wonder how this could possibly be. I thought these were no-lose stocks. You can't lose. Trees grow to the sky. This was never going to end. Everybody was going to hold the line. Everybody was going to destroy the big guy. $483 last week to $53.50. And you think there weren't other big hedge funds and other traders who didn't short sell this back down and profit from all of that, either selling the shares short or buying put options? Give me a break. It's ridiculous. This is what I'm telling you. People don't understand what's going on. They're following some idiots on a social media platform because, if somebody says it online, it has to be true. Regulators likely discussed the online forums where mass buying of the stocks of those two companies were discussed last week, and the ever larger role played by hedge funds and financial markets. The SEC is reviewing social media posts for signs of potential fraud, according to Bloomberg News. Sherlock, you think there's fraud in these markets? We know there's fraud in these markets. And when those are typically caught, when the big boys are caught, they get a slap on the wrist. They get a deferred prosecution agreement. We're going to see who gets made an example of in this one. Before calling the meeting, Yellen sought and received permission. Here it is, the ethics question. Yellen sought and received permission from Treasury ethics lawyers to do so and ensure that she was in compliance with her ethics agreement. Reuters reported on Monday that such an ethics waiver might be necessary because of the over $700,000 in speaking fees that Janet Dingbat Yellen was paid by Citadel LLC, a hedge fund that has been at the center of the GameStop trading saga. You got that right. A central banker who was in her position a regulator of the financial industry Once she retires or is no longer reappointed, I guess, to another term as the chairwoman or the chairman of the Federal Reserve, she goes out on a speaking tour, and she collects $700,000 just from Citadel hedge fund alone. Not to mention, I think it was several $1 million in aggregate over the past several years when she was no longer with the Federal Reserve, talking to banks and other financial institutions. But, there's no conflict of interest here. They have, again, the nerve and the audacity to tell us about ethics. Citadel, whose trading arm profits from processing trades on the Robinhood commission-free trading app favored by many retail investors, had provided a $2.75 billion lifeline to Melvin Capital, a hedge fund that had suffered major losses in the GameStop short squeeze. So you see how everybody is in bed together with each other? You see that? Citadel hedge fund being one of the largest customers and clients, if you will, of Robinhood, because that's who they're selling their order flows to. Because again, as I stated earlier, Robinhood does not charge commission, so in order for them to make money, they sell the order flows, which is basically the buy and selling and all of the action that is taking place on their platform, and hedge funds and other institutional investors can purchase that data, and they get a sense as to where the retail market is moving, and they can get ahead of it, they can trade with it, they can do a whole bunch of things to make a lot of money with that information. And of course, they were at the middle of all of this, bailing out one of the hedge funds that was taking a bath last week with the short squeeze with respect to GameStop. And Janet Yellen received $700,000 from this hedge fund to give a speech. Have you ever seen this woman? Have you ever heard her talk? Who in their right mind would spend $700,000 to have this woman over to say anything? But they did. And I wonder why. Do you think they expect something in return? I bet they do. And the Treasury Department has an ethics division. Who would have thunk that one? Our whole government probably has an ethics department that signs off on everything. This is the world in which we live in. But there's no fraud, right? There's no fraud. There's nothing to see here. There's no inflation. There's no further job loss. Everything is fine. This is what they want you to believe. Whatever they got to sell you, they're going to try to sell you. This is it. Jobs slide, markets high. I mean, this is like a continuation. This is almost the headline it should be every Thursday. Because there's almost no such thing anymore as bad news. It's all good news as far as the markets are concerned. More people losing their jobs, market goes up. They don't care. This number probably could have came in at 1 million. Market still would have went up. Because it justifies everything. If everything is coming back, oh, good. Then there's economic growth coming. And if it's worse than expected, oh, well, then we have to print more money. We have to spend more money. We have to borrow more money. Can't lose. And that's not right, because that's simply not true. Stocks don't just grow to the sky. There's corrections, and this is going to be devastating. It doesn't mean that this insanity can't continue further. It most definitely can. Most definitely can. But the higher it goes, the further it falls too. And a lot of people just aren't going to see this coming. So I hope you're doing your best to sort of get the news out, get the word out about the Capitol news, and to start educating your friends, family, complete strangers about what's going on. Most of them don't want to hear it. But you have to wake them up, because you want people to be as proactive as possible and not reactive, because by that time, it's most likely going to be too late for most people. So with that, you'll either catch me here tomorrow for the jobs report or over the weekend, and we'll see what happens there. Stay diversified, stay vigilant, and stay with the Capitol News. I am Alex Kreitis. Godspeed.